Hello and welcome everyone to the Capitalmind podcast. If you'd like to know more about us, visit capitalmind.in. And if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capitalmind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to episode 31 of the Capitalmind podcast. Deepak is busy answering his MBA exams. Yes, you heard that right. He's actually answering his MBA exams. It's a regulatory thing. So because of that, we've decided to do a very different episode, and we're doing it with one of our newest colleagues, Sandeep Rao. Sandeep joined Capitalmind a few months ago, and he had built his reputation by running the successful site niftyscalper.com, which is a blog dedicated to quantitatively trading indexes on a short time frame. He's also worked on creating market breadth studies and designing trend following strategies. And it's the trend following strategies, that we're going to get into today. Let me also add that Sandeep isn't what you might expect for a typical derivatives trader. Believe it or not, he's got a bust of Karl Marx on his desk.
I wish this thing was going to become contentious, Shray. Anyways, I should have got Adam Smith's bust as well, just to make it even.
Fair enough. We'll tweet that out when you actually do that, okay? Achha. So Sandeep, congratulations on putting your money where your mouth is and with the launch of Capitalmind Chase. I think as you've described it, it's a systematic trend following strategy. And I have to admit, the returns, the backtest, and all the numbers, they were absolutely astonishing. If I have these numbers correct, when you look back, since 2008, this strategy has delivered something like 26.3% on average, or a median of like 18.9%. And it's outperformed a Nifty buy and hold strategy pretty much every year. In fact, I believe that's one of the reasons that you have a lot to say, and it's not very positive about buy and hold strategies, right?
I sure do, Shray. More about it later.
Fair enough. Now, look, Sandeep, as you know, normally when people come to us with a backtest that shows it's going to take over the world, we look for the fine print or the things that can't be replicated. And this time, well, we've done that exercise, and our fairly demanding customers have done that exercise as well. And enough people think that there's something here, and they've actually put their money behind this and are actually going to give this a shot. So, Sandeep, that's why we brought you up here today. We really want to dig into this strategy and everything about it. So let me just get started with the first question. Can you tell me, what is trend following?
Let me split that question into two parts. So let me start with the first one, that is the word trend. What exactly do we mean when we say, when we use the word trend? So trend is price persistence in a direction. What it means is if price starts moving up, it continues to move up. And if it starts going down, it continues to go down. There are two more aspects to trend. The second one is trends are fractal in nature. What that means is if I chart if I share two charts with you and I don't tell you what time frame they belong to, they may look very similar. But in reality, one could be an hourly chart and the other one could be an yearly chart. So it's quite possible, but they look very similar. So that's what it means when we say trends are fractal. The third aspect is they're present across asset classes, which means you would find trends in commodities, in equities, to real estate, you name it. So that's what is a trend. Now, moving on to what trend following is. Trend following is a method of measuring or quantifying a trend so as to trade them. Now, essentially, it's a systematic way of identifying a beginning and the end of a trend. And we also need a product to trade it. So we can do it on a single product, or we could do it on a basket of products. At Capitalmind Chase, we are doing it on a single product. So that's what is trend following.
Well, I think I've seen your chart. So when there's a trend, you'll know it when you see it. I mean, it's kind of incontrovertible. I get that. But this, if you don't mind, I'd like to get a bit existential here. Why do these trends exist in the first place?
Anecdotally and historically, we all know trends exist. So I'm equating the word trends here with fads and bubbles and so on. So we all have read about things like tulip mania, which happened in Holland, to the housing bubble, which led to the 2008 crisis. They do exist. But then your question is as to why do they come about? Why do they exist? So if I have to look at it, I would say that we as a species have not evolved much in terms of how we behave in crowds. And that in turn leads to trends. I know this is my answer is very meta, but that's what it is.
Okay. So look, the answer is human nature in a way, right? So this makes me question, look, is there literature supporting this, or is this just the observations of like traders and practitioners like yourself?
Shray, if you look at academia or academic finance as such, and go back in time to, let's say, 60s and 70s, they were more occupied with a few other questions. Things like capital asset pricing, efficient market hypothesis. Those were the things which was occupying academic finance. So this whole group of people, from Sharp to Merton, Markowitz, Samuelson, Farmer, you name it, largely from Chicago and MIT, they were all trying to look at markets from an efficient market standpoint, from a capital asset pricing standpoint. So that's what they were busy with. So on the other side of efficient market was market inefficiency and anomalies. So work on that side started somewhere by late 70s or 80s. And Schiller was one of the prominent critics of efficient market hypothesis. And, trends belong to this side, which is the inefficient side or the anomaly side. Post 80s, there were a few other researchers who've done work. It could be, Jagdish and Titman, who did work on time series momentum, which is again a kind of trend following system. So yes, so there's been support from academia, definitely. But talking about academia, actually, I'm reminded of an interesting anecdote, a paradoxical one at that. So I was reading this book called More Money Than God by this author, Sebastian Mallaby. And this book is about hedge fund folks, and there are a lot of people mentioned, but there's this chapter in the book called Samuelson's Secret. And this is the same Samuelson, the economist Samuelson, who contributed to the efficient market hypothesis. Now, it looks like Samuelson also happened to be one of the initial backers of an extremely successful quantitative trend following firm by the name Commodity Corporation. Okay. Now, which is a paradox in itself, because I would have thought Samuelson to be a sort of passive investor in an index fund, but turns out that he somehow did believe in marketing inefficiency. Okay, so that's the story.
Right. Well, Shike, so there is literature and a bit of weird details on that as well. Can you come to the practitioners or the traders part? What do they have to say about this?
Practitioners always knew trends existed. And if you go back in time, again, economists like Ricardo, who was himself a trader, Keynes, who was again a trader, all of them have commented to some extent on the existence of trends. More recently, if you look at data from CTAs and hedge funds world over, even before literature started supporting the existence of trends, practitioners, started trading trend following systems. So practitioners were a bit ahead of time, definitely. And they've also written a lot of white papers and all that, but I'm not really quoting them because they are sort of interested parties in it.
Okay. So, Sandeep, fair enough. So, you'll know a trend when you see it. It's something that has backing in both academia and in traders and practitioners like yourself. And you've certainly spent a lot of time on it. So, here's another question I have for you. You've established these things exist. So, now if I do all this effort, and you're going to talk about that, I know, because this is a lot of effort. So if I do all this effort, what's the potential or upside for me for doing this? I mean, Vanguard and their ETFs have basically taken over the world, right? So why do I spend time and do this? What can I get?
Well, yes, if there's a lot of effort, definitely. But let's look at the potential of putting in that effort. The potential of putting in that effort is one. You would be, first things first, you would be able to save yourself from sharp drawdowns. So you protect your downside. The second thing is, on the upside, you would be able to generate an alpha. Okay. And so you put both these together, so your total alpha on the strategy increases because you're protecting yourself on the downside. On the upside, you're kind of making 2x returns. What else could you ask for?
I think you stated it upfront. So look, I'm interested, but how? Is there some kind of leverage or some kind of unusual risk here? What am I missing? 2x on the upside and no downside. You can see why this is a bit too good to be true, right? So can you fill us in on what's going on? Yeah.
I know where you're coming from. Let me ask you a question, Shray. Okay, so you've been an investor in the market, and you've been largely a passive investor. So, and you've not done derivatives much. That's what I understand. So, let's say, so as a passive investor in the market, what kind of risk rewards realistically do you expect?
Well, you've chosen a very opportune time to ask that question. So, in terms of rewards, let's get to that. The rewards seem to be right now like barely beating fixed deposit returns. So that's not very encouraging. So I don't know, let's call it 8% for sake of argument. And the risks, as I've experienced twice in this period, have been something like a 30% drawdown, albeit fortunately temporary in both cases. But yeah, that was the risk, I'd say.
Yes. So that's pretty much what it is. So you expect a CAGR of around 8%, and once in a while, maybe once in a decade or twice in a decade, you are open to seeing a drawdown of around 30-40% on your portfolio. Okay. So that's what a buy and hold investor would expect. But then let's look at it this way. What if you were a person or you happened to invest at the wrong time? And what if you had to exit at the wrong time? So buy and hold becomes a thing of about timing, because if you, for some unfortunate reason, don't get your timing right, then your whole return profile goes for a toss. So that's one. So we looked at, with that as the context, let's look at what are we trying to do in this strategy. Okay, so here what we're trying to do is, as I said, we are trying to protect our downside. So which means even when the market goes down, the way it works is, let's say, let me explain how the strategy works. I think that makes more sense. Okay, so we start with, let's say, investing in a Nifty ETF or a mutual fund, a large part. And how much do we invest? We invest a notional equivalent. For example, so if you are trading futures, then you would invest 75, which is the lot size, into spot. Let's say it is around 11,000. So around 8.5 lakhs is what goes into a Nifty ETF. So that's where it stays. And then there is an active component of the, and that's, the ETF is the passive component. And then there is an active component of the strategy, and this active component is traded through futures. So the active component is both long and short. So there are times where we would be short on futures. There are times where we would be long on futures, and that's how the whole strategy works. So if the market goes up, we are long on futures, and the ETF is long anyways. So we get 2x returns. When the markets are going down, we are short on futures, and the ETFs remains long, and we are trying to cover our losses to the extent possible. So that's how it works, and that gives us a far better return profile compared to buy and hold. In terms of risks, if I go back and look at data for the past 12 years because we wanted to include 2008, which is a bearish cycle. Okay, we've never had anything greater than, let's say, 11% drawdown, which is far better than, let's say, a buy and hold strategy where you're willing to see a far greater drawdown. But yes, it includes, that means a lot of effort. But nevertheless, the risk is far lesser here in Chase compared to, let's say, a buy and hold strategy. That's what I wanted to say.
Yeah, fair enough. Also, one thing, the current 8% return, I certainly hope that's not what the buy and hold yields going forward. I think that might have just been, as you said, a quirk of the timing. But
I hope so
as you described this, I think I get it. About how you make more money on the upside and cover your bases on the downside. But I don't know if you remember, but just earlier this summer, there was this really horrific article about how some early 20-something guy on Robinhood was playing around with options and futures and stuff like that. And he woke up a couple of days later to see a negative $1 million balance on his account. And I think it ended really badly, where the guy ended up killing himself. Now, I guess why I bring up something as sordid as that is, can you tell me, the moment you have instruments that perhaps we're not that super familiar with, my immediate reaction goes to, so sort of, can you tell me what's the worst case scenario? What truly is the worst that can happen? Can you give me some perspective based on, 12 years is a long time frame. So what can you look for as, will we also wake up one day to see a catastrophic loss of capital? What can it be like?
I hope not. So let me share what is the worst that's possible. Now, as I shared, we are levered on the upside, which means if our system signals a long, we are long on the futures component, and we are anyways long on the ETF component. Now, that's the that's a situation in which we are, at risk if something goes wrong because we are levered. So what is it that can happen? So let's say if we are long on futures and we are long anyways on ETF and market crashes. Okay, the next day there's a gap down in the market and market crashes. That's bad for us because we are going to lose on the ETF part, notionally at least, and we are going to lose on the futures component as well. Now, how much can the market fall? So let's ask the next question. If you look at how the markets are, designed, so we have something called circuit breakers on indexes. So the first one is a 10%, then there's a 15% and 20%. So markets, if it falls 10%, trading would halt for the day, and they would, wait for around 45 minutes and then resume trading. If it falls another 5%, which is 15%, then again trading would halt and then, resume. After that, if it falls again another 5%, which is 20%, they would stop trading for the day. So that's how it works. So assuming that we were long and, one fine day, market opens 10% down and then, we were not able to exit, and then it falls 15% down, we were still not able to exit, and then it's 20% down, and somehow, let's say, so that's the worst that can happen. Okay, so I'm hoping you would get an exit somewhere here in this process and you would be able to reverse your trade. But still, if not, you may end up losing 40% of your capital. Though it has never happened in the past, this is more what could happen if, worst case, what is imaginable, this is what could happen.
Okay, so I mean, I have to say that doesn't paint as bad a picture as you might say, because in this essentially traumatic event, which has not happened up till now, I mean, you're still losing less money than you've put in. You're not looking at it going the reverse direction. Okay, got it. But I did seem to understand a bit more about a market dynamic that might be unfavorable to you, because as you mentioned, you make money when things go up. You also don't lose money when things go down. So, but that surely means that if you're in neither of those situations, which is some kind of maybe sideways movement or something like that, that's like a market regime that might be bad for a strategy like this, right? Or could you talk about that?
Yes, Shray. So choppy markets are pretty bad for us. And it's quite possible, historically, if I look at the data, there are months and months of choppy markets sometimes. And so what happens is our futures component would, keep getting whipsawed or more in our stop losses. We won't get a trend to ride on. So we would keep accumulating losses on the future component, though nothing much would happen on the ETF component. And that's bad. But then typically such regimes don't go beyond 2 months or 3 months. So we've had those regimes in the past. If I look at 2011 and even 2017 and so on, so there've been those 2 or 3 months, but typically after those 2 or 3 months, we get a trending phase where it would cover our losses and maybe add a bit to our returns as well. So that's how it works. But it's important that we continue with a strategy for a long period of time so as to cover these phases and also get the best out of the trending periods. I'm reminded of this thing. I was chatting with one of our premium subscribers, Neeraj, who said this beautifully. He said, long-term investing is highly overrated and long-term trading is highly underrated. So I think if you are in the system for if you follow this particular strategy for a long period, for 3 or 4 years or 5 years or more, you would end up positive and you would be able to ride the better regimes, as well as you'd have to go through the not so conducive regimes.
Well, I have to say that's a breath of fresh air and some very contrarian stuff. I'm so used to hearing all the Warren Buffett style lines of buy and hold forever and so on. But that was fair enough. But look, if I could ask, and maybe a bit tongue-in-cheek on that, can you elaborate on the strategy? I mean, how do you know when the market's going to go up and you should move the future into a log? And how do you know when the market's going to go down? I mean, that obviously is a pretty key part, right? So do you think you could talk about that a bit?
Now, we don't know, actually speaking, if the market is going to go down, nor do we know if it's going to go up. Okay, so that's what is trend following in a way. So we don't try to predict. What we try to do is we follow some quantitative method to compare the current price with a previous time series or previous average price to see whether price is trending up right now. The way we do it in Capitalmind Chase is we use moving averages. So, for example, we use a fast moving average and a slow moving average. So, let's say the fast one is a 10-day average and a slow one is a 60-day average price. So if the 10-day average price is above the 60-day average price, we go long. If it's the other way around, we go short. And and we hope that the price continues in that direction, which does not. But sometimes it does. And sometimes once the trend starts, it continues for weeks together. Those are the trends where we make money. And then there are other trends where it just chops around and we don't make money. So that's how it works.
Okay, thanks for that. Now, you look, that actually sounds not too difficult. I mean, if I could put that little simply, I mean, these moving averages are fairly well understood concepts. I've seen them on broker screens and so on. So, is there more to this strategy than the rules you've just laid out, or is there some secret Sandeep Rao discretion that you're not sharing with us, and that we have to hope that you continue to maintain that edge?
Well, there's definitely some proprietary aspects to it in terms of specifically at what point do we enter and so on. But then it's still simple. It's not really rocket science. Coming to the discretion part, there's definitely no discretion whatsoever. There's this thing which they say in the quant world that you test what you trade and you trade what you test. The moment we bring in any kind of discretion, we have to throw the backtest out of the window because it just does not make sense. So if your question was about discretion, no discretion whatsoever.
All right. So Sandeep, something that's been puzzling me while you've been bringing this up, you're fairly compelling in this pitch, and I've seen a few folks on Twitter who bring it up as well, and they talk about it. But the fact of the matter is that you're not getting calls from bank relationship managers. There's no other people out there who are really advertising a product like this to you. And I'm really wondering why that's the case, because this makes us such a good sales pitch in that sense. I mean, so much more on the upside and downside protection. So are there other products and offerings that incorporate this, either the same way you've done it or just as a principle? I mean, I don't really seem to see anything. Why is that?
I get where you're coming from, Shray. So let me, talk you through the investment product landscape. So one is you have mutual funds. So if you have mutual funds, there is a category of mutual funds called dynamic allocation funds, which may have a trend following component to it. But mutual funds by regulation cannot have derivatives, especially they cannot bet on the downside. So even though they have a component of trend following, they may have a component of trend following, but they're not going to cover your downside. The second piece is ETFs. Again, very similar to mutual funds. We do not have the whole thing, this thing called inverse ETFs. So again, we cannot bet on the downside with ETFs. Coming to two other products, PMSs, we are one of them. Can have trend following based long only strategies. We have momentum, which is again similar to trend following, and there could be other PMSs who have similar products. But again, regulation does not allow derivative product, especially levered derivative products. So that's out again. The last category is AIF, category 3, which can include derivatives, long, short positions, everything. But the problem with AIF category 3 is the tax structure, specifically the HNI surcharge, which makes it very difficult for fund managers to generate any meaningful return with AIF. So that's what is the landscape. So
Sandeep, I actually agree with you. What you pointed out was that mutual funds and ETFs, in a sense, they really wouldn't want to sell something complicated like this to their end user, and it's a bit not in their scope. PMSs have limitations, and so can't really do it. And while an AIF can, and I've seen a few, the tax surcharge really does kill you, and it's quite painful. So Sandeep, the best way to do it is by following someone like you, right?
I hear that snark, Shray. I'll talk to you about it, but the point remains. Yes, there's no other choice at the moment. On a serious note, there could be individuals like us. There could be investment advisors who may be running similar portfolios. But talking about these products which are available for investors in the market, you wouldn't find something which is exactly the same. You would find a long only trend following product, but not really something which is long and short.
Okay. Let's get to the implementation of this trend following that you're working on right now, CM Chase. So, Capitalmind Chase, why did you choose to launch it? What's the goal behind it?
If you look at Capital Mind portfolios, that is prior to Chase, we had a long-term portfolio, we had a multi-cap portfolio, and we have momentum. Though momentum is trend following, but it's long only, and others are obviously long only. So we didn't have any product which helps us cover the downside. So that was one of the elements in the design principles while we were looking at designing or creating Chase. So that was one. Second is we also, so we could have done that using options, but we thought it makes no sense to just cover our downside. Why not look at adding alpha on the upside, because in the long run markets go up more often than they go down. So while it's important that we cover the downside, we also need to add some alpha on the upside. And that these were the two ideas which drove us to create Chase. And that's how we ended up with this whole futures plus an ETF kind of a design. So yeah, so that's what it is.
So, Sandeep, I think actually your point is a bit broader here. It's not just the other Capitalmind products, but if you look at it as a retail investor, pretty much everything I have in the equity space is long only. I mean, that's how really my world works. And I'll just digress for a second, because I remember attending this conference where you had people from different asset classes, and at least the VC folks, venture capital folks, had made it clear that they were really, in a sense, in the hits business. If they made 10 investments, they relied on one or two of them to return the fund and deliver all the returns. And the other 8, they at some level didn't care, and it didn't matter to them whether they even got their money back on them, if you really wanted to take it to an extreme. Whereas that was clearly not the case for retail investors. And someone pointed out that during one of those 30% corrections, like you pointed out on the buy hold, that's when people often exit or end up biasing their future decisions based on that. And it's those really painful downturns that really cause a lot of investor wealth destruction in the retail space. So in a sense, you're trying to almost balance the scales, right? I mean, make people make some money or not lose as much money when equities are falling. Sandeep, I'd like to get into a couple of, let's call it specific or rapid fire type questions on Capitalmind Chase. Can we go with this?
Sure.
All right, chalo. First one, how much capital do I need?
You need around 9 lakhs at the moment, and that's how we calculate that is 8 or 9 lakhs is the notional value equivalent, which means if you look at one lot of Nifty futures and multiply that with spot, so you get this value. So that's the money that you need to get started.
All right. Who is this strategy for? Who's the best customer for this or the best client for this?
The strategy is for anyone who has a long-only exposure to the stock markets. It could be through Nifty ETFs or index mutual funds. It could also be for someone who's invested in the constituent stocks of the index and does not have any protection on the downside. So it's for that. And this is... Also, another thing which is important is for this strategy, you need to have access to your terminal or your trading platform during market hours. And lastly, because there is a futures product involved, you need to have a sense of understanding of how derivatives work, especially futures.
Equally important, or maybe more important question, who is this strategy not for?
Well, this strategy is not for someone who can't actively trade or who's going to miss any of the signals, because most of the signals come during market hours and you need to take all of them. We're not in the prediction business, so we don't really know which of the signals would work. So you'd have to take all of them. 2 is you need to be psychologically okay with lumpy returns, because there'll be phases where we are going to make losses, and there'll be one big trade which would cover for all those losses and give you some returns on top of it. So you have to be okay with that kind of a lumpy return profile. And more importantly, you need to have investments in the market which you would like to hedge against. So it's so either in the form of ETFs or mutual funds. If you don't have any investments, then trading this system by itself, only the futures component, is not something which we would recommend.
You've brought up having access to your brokerage account during the day and being active. So look, what do you mean by active? How active is active?
If you look at the data, Shray, we typically get on an average 5 to 6 signals in a month. and but that's the average. But the distribution is not so linear. So what happens is there are months where you would get 1 or 2 signals, and then there are months where you get 8 or 9 signals. So, and the months where you get 1 or 2 signals are the months where you make money, and the months where you're getting chopped around 8 or 10 signals are the months where you don't make money. So you have to be okay with this kind of a profile. But on an average, it turns out to 5 or 6, but in reality, it'll be less than 5 or 6 in a few months, and more than 5 or 6 in a few other months in terms of signals.
All right. So Sandeep, as I said, this is fairly compelling, and it's not just me, but there's many other people who've decided to actually sign up and give this one a spin and see where it takes us. So I'd like to ask you, let's say someone's hearing this podcast and they find this interesting and want to learn more. Where can you lead more? I mean, about this strategy or just trend following in general?
Okay, the best content according to me is on the Capitalmind site. Okay, I'm kidding. All right. So, well, yeah. So there is a series which, on a serious note, there is a series which I'm doing. We've done around 6 posts right now, which is about everything about trend following. And it's also explains Chase to some extent. So those who are interested may want to have a look at that. Beyond that, if you want even better content, and if you're into books, then books by Andreas Klenau on trend following. And there's another book which I'm reading currently called Crisis Alpha by a lady by the name Catherine Kaminsky, which talks about how during times like March 2020, trend following strategies do far better than other strategies because they're able to capture trends on the downside as well. So that's something which I'm reading right now. So yeah. So those are the 2 books.
Well, thanks. We'll definitely write those in the transcript and the show notes so that people can both look at the article, which I think is like, as you said, it's an exploration of trend following in general. That's the keyword to look out for. And we'll mention these books and some links to them. So Sandeep, with that, thanks a lot. As I said, this was a interesting episode. We'll have Deepak back next time, and maybe he'll have a slightly different take on things. But on that, just like to say, so if you'd like to read more about what Sandeep has to say about markets, economists, and others, he's on Twitter at mysands. That's MYSANDZ. Our CEO Deepak Shenoy is on Twitter at Deepak Shenoy. Capitalmind is on Twitter at Capitalmind_in, and the website is capitalmind.in, where you can read those articles Sandeep was referring to, and where you'll be able to see the transcript for this podcast as well. So thanks everyone, and let's see where these trends take us. Bye-bye.